Okay, hello guys, welcome back to my favorite channel. Right now, I want to say about an investment in knowledge pays the best interest. Ben Franklin spoke the truth, especially if you own real estate. Knowing how to use expense and lose deduction properly can increase your after-tax return. You can even start at home, which is convenient since the first significant real estate purchase most people make is their home. After purchasing a home, many people move on to Rental property. Fortunately, the Internal Revenue Code provides tax incentives to both homeowners and rental property investors. These tax benefits can these tax benefits can enhance your return when the real estate market is good and maybe your only return on investment when the real estate market is in a slump. In this chapter, we focus on many of the expenses and deductions that make home and rental property ownership so NTC. mm, NTC. However, if you are a real estate investor, you will also need to carefully read the next chapter where we cover perhaps the most significant tax deduction, depreciation. In the next chapter, we also explain how the IRS limits the use of all deductions with the passive activity loss rules. Principal residence expense and deductions. In these sections, we outline some of the most commonly used expenses and deductions available to homeowners, including home mortgage, interest, points, and home office expense. We also discuss the difference between making improvements and repairs to your home and what that means to your bottom line. Deducting mortgage interest. One of the biggest reassuring tax advantage of owning a home in the ability to reduce annual income tax by deducting home mortgage interest payments. Generally, home mortgage interest is any interest you pay on a loan secured by your principal residence or a second home. Home mortgage interest can come from a home purchase mortgage, a second mortgage, home equity loan, or a line of credit as long as it meets certain tests. Home mortgage interest specifically excludes interest paid on personal loans. Personal loans include things like automobile financing and credit cards. The, the initial test you must pass in order to be able to deduct home mortgage interest are you must file from 1040 and itemize deductions on Schedule A. You must be legally liable for the loan, and the mortgage must be a secured debt on a qualified home. Form 1040 is the U.S. individual income tax return. Schedule A is for taxpayers who itemize their deductions rather than take the standard deductions. As the rule says, you must be legally liable for the loan. You cannot deduct interest payments you make for someone else, like a family member, unless you are legally liable to make them. In addition, the loan must be a bona fide debt that is intended to be repaid, and it must be secured by a qualified home in which the taxpayer has an interest. A qualified home can be a house, cooperative apartment, condominium, mobile home, houseboat, or any other property that has basic living accommodations such as a sleeping space, a toilet, and cooking facilities. If you are building a home, you may treat it as a qualified home for up to 24 months, provided it becomes a qualified home when it is ready to be occupied. Next, repayments of the loan must be secured by the qualified home. To be secured, the taxpayer must have signed a legal document, typical a mortgage or deed of trust, that one makes the home security for repayment on the loan. 2. Provides that the taxpayer's home could be used to pay off the debt in the event of default. And 3. Is recorded or otherwise perfect based on local and state law. Home mortgage interest versus personal loan interest. The possibility of interest deductions and lower interest rates are why many advisors recommended paying off non-deductible interest on automobile loans and credit card debt with a home equity loan. If these tests are satisfied, most people most people are able to deduct the full amount of all of their home interest payments. However, there are limitations. Your home mortgage interest deduction is limited to the total of the one maximum allowable home acquisition debt, 2. Maximum allowable home equity debt, and 3. Grandfathered debt. Home acquisition debt is a loan secured by a qualified home take out after October 13, 1987 and used to buy, build, or substantially improve the qualified home. Only debt that does not exceed the cost of the home plus improvements can be home acquisition debt. Okay, guys. Until here, first for today. See you in the next video. Bye bye.